Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como with Ireland Como Lafoy Consulting. Today we got a good show for you. We're going to talk a bit about biofuels. Some headlines recently are suggesting that biofuels are a bad idea. This is coming largely from the scientific community. We're going to talk about a couple of events that may affect the outlook for biofuels, or at least the public opinion on biofuels. We're also going to talk about the Canadian dollar. And of course, we're going to talk about the updates to the markets, some positives still, like canola and corn. So let's get into what is happening in markets today, or what happened in markets today. We did see canola slip $2.80 to 617.60. We saw Minneapolis wheat fall 1.5 cents to 549.5. Kansas wheat up a half a cent to 488 and three quarter. Chicago wheat up 3 3/4 to 502.5. Soybeans up 4 1/4 today at 10.75. Corn up a nickel at 421.75. Some good technicals there. Soybean oil up 7 points at 50.87 cents per pound. Canadian dollar slid to 71.18, which is really only down 3 points. Live cattle making another new high today, 247.88, and feeder cattle not quite making a new high, but still up today, 380.95 per hundredweight. All right, let's take a look at some of these charts. I know I just quoted you on the November canola, but again, we are watching the January canola with a little bit more interest as it has more open interest and more volume. As you can see, yesterday's move above the 20-day moving average and above the channel still is in place, even with today's losses. So we consider that a good sign. It is the time of year where we expect to see some gains in the canola market after the harvest push malaise. That doesn't mean that we think that it will last forever, but we are feeling a little bit more confident about canola at this point. Same thing you can say about corn. Look what corn did today. It traded well above its 20-day moving average, closed above that. And even there's a minor trend line there that we saw it close above as well. So there might be an opportunity for corn here as the significant amount of harvest is now completed, and we're getting towards the end of that pressure period as well. Spring wheat may be the opposite here. We saw a new low in spring wheat today, although you can tell that it's really grinding lower here today. Not big volume or not big volatility moves in this market. We are still dealing with low volume and low open interest in this contract, so we always look to other markets to kind of gauge what's happening in the wheat market overall. Last 3 days, we've actually seen some up days in the hard red winter wheat market. We expect it to kind of come up and test this 20-day moving average. That will be the litmus test, though, if we can trade above that or if it's going to stay in this channel locked in a lower grind lower. Same thing with December Chicago here. A couple of up days, or at least the trend over the last 4 days has been higher. It could mean that we are going to test the 20-day moving average again. And I know that doesn't get anybody excited much, but that's just what we're seeing in the charts right now. One interesting thing that we're seeing is that spring wheat to hard red winter wheat spreads are still kind of trading in that range. So we could just be seeing some spread contraction here as it moves lower, down towards 55 cents spread instead of, 70, 72 cent spread. It's currently at 60 3/4 cent spread. So kind of right in the middle, but it has been kind of jostling back and forth in between there. So when we see losses in spring wheat and gains in hard red winter wheat, like we did today, that spread weakens. And when we see the opposite happen, if we see spring wheat go higher and winter wheat fall, or if spring wheat, trades higher relative to hard red winter wheat, we see that spread go up. So that's pretty normal at this point in time, which is why we're not necessarily sounding major alarm bells on new lows in the spring wheat market. Soybeans had a pretty good day today, although I wish it would have closed a little bit different. We did see it punch up to about 10.37 today, but it did settle back down at 10.28. It does look like it has some momentum to try to bring prices up above that 20-day moving average. That's what we would like to see in order to get us, nice and positive here in the soybean market. Of course, lots of headwinds here on trade relationships between the US and China, but NOPA did report a good crush today, up 4+% from last month. So good numbers coming out of NOPA, but still some weight in the trade news for soybeans at this time. We have seen kind of a rising trend in soybean oil as well. It moved above its 20-day moving average decisively yesterday, although it still closed lower from the open to the close. But we're still seeing trade above the 20-day moving average here again today, which is also kind of right in line with the 50-day moving average. So Some positivity out of soybean oil, but still not out of the woods. It's still more range bound in the last couple of months. Now let's get into the biofuel discussion. This was an article in New Scientist today. Very biased here. Obviously, the science community, our biofuels a good idea, and they're putting the blame here on farmers. Only if you're a farmer or shipping company. And what they state in the article here is that is biofuels a good idea? It's obvious it isn't. Is it really obvious? Plants turn sunlight into food, stored energy. So if we turn that food into fuels, we should get sustainable fuel with zero carbon emissions, right? And they say it's wrong. Um, the growth in biofuels, in fact, increasing emissions and also hurting both people and wildlife. Yet instead of stopping, we are doubling down with production rising fast. So there is some pushback on the biofuel program from the scientific community. Now, interestingly, Brazil is going to ask other countries to quadruple the global use of sustainable fuels, including biofuels or controversial biofuels, despite concerns from environmental experts. The Guardian reported. There was a leaked document seen by The Guardian that sets out a draft pledge for world leaders gathering at the COP30 climate conference, which is next month in Brazil, to increase the use of sustainable fuels, chiefly biofuels and biogas, but also some other gases. Brazil is the world's second largest producer of ethanol, one of several types of biofuel. It argues in the document that biofuels made from a wide variety of organic matter, such as sugarcane and ethanol, will displace fossil fuels and they will represent a benefit to the climate and environment. But of course, this is disputed by the green experts, as we just mentioned, that biofuel production results in deforestation and replacement of land with rich species and microcultures and that sort of thing. So, I think there's going to be an increase in a debate about this subject, and I think that our biofuel market and our vegetable oil market might see some volatility, not in the coming weeks or months necessarily as a result of this, but in the coming years. I don't think anything is quite set in stone. President Trump continues to seek leverage over China in the trade war, saying on Tuesday that Washington is considering halting purchases of used cooking oil from China unless it resumes purchases of American soybeans. Um, so this kind of has been supportive to soybean oil prices and canola prices, although very marginally. Earlier this year, Trump administration already cut subsidies for biofuel production from imported recycled oil from China and canola oil from Canada by 50%, incentivizing the use of American origin cooking oils in biofuel production, which is consistent with his America First policies. No surprise there. Um, November canola futures rose by 2% in two sessions here now to 620 for the week. And even though the month has been lower, this is amid statements by Trump and the Chinese ambassador to Canada, who said that China is ready to lift the ban on canola imports from Canada if Canada's government removes tariffs on electric vehicles from China. So China is signaling to Canada that it is willing to remove the canola tariffs as long as we remove the electric vehicle tariffs. I think this is going to be a very difficult dance for Prime Minister Carney to make. Although I think it's clear where his biases would line up with, which would be voters in his largest area, which would be Ontario, which is more automotive centric than agriculture centric. I don't think there's not a lot of seats that Carney won in the last election here in Western Canada. So it won't surprise me to see where his allegiances lie. I think this will be an uphill battle for us here in Canada for the foreseeable future here. Let's turn to the Canadian dollar here. The Canadian dollar is kind of stuck in this neutral position this week, which is unable to shake off its slump, even after some fundamentals have turned in its favor. This headline here, Canadian dollar struggles for direction as USDA CAD holds above 140. Now, normally on this channel, we talk about the Canadian dollar in the inverse to the US dollar, meaning like 71 cents or 72 cents per US dollar. What the most of the trade does trade though is the dollar Canada um, pair. This is the way it's more commonly uh, illustrated in the trade community, not necessarily in the media, but in the trade community. So, there is some policy divergence that's keeping the loonie on its back foot here. The biggest factor working against the Canadian dollar right now is it's the widening monetary policy gap between, the Bank of Canada and the Federal Reserve. So, Markets are expecting the Bank of Canada to trim rates by roughly 33 basis points over the next year, essentially one cut with a slim chance of a second cut. The Fed, on the other hand, is projected to slash rates by over 100 basis points across four potential cuts. So that's a quarter point each, with traders even pricing in a 50-50 shot of a fifth cut. So normally the expectations for faster US easing would weaken the greenback, but that hasn't been the case. In fact, the USD, or the US dollar, remains well bid right now, with investors treating it as a safer bet now amid mixed global and political uncertainty. So there's lots of countries that are experiencing political uncertainty, largely because of some of these trade wars and things like that. But the U.S. Federal Reserve cutting rates gives people more confidence in investing in the U.S., which is interesting, given that the yield that they will receive on that investment will move lower. But it's still gaining some momentum on that back of more of a safe haven. At the moment, markets see a 99.8% chance of a Fed cut on the October 29th meeting to just 52% odds for the Bank of Canada. So that imbalance continues to anchor these two currencies near the top of that 140 trading range. Another thing hammering the Canadian dollar recently has been crude oil. As you can see, back in into the middle of the month here, crude oil decisively broke the previous low that was put in place on August 11th, opening it up to a test of this June low. Today, we broke that June low, which again opens up the possibility of a test to 55-ish dollars a barrel. So the Canadian dollar, being a uh, mineral and crude oil rich country where a lot of the investment from Canada comes derived from some of those industries, this is a net negative overall for the Canadian dollar. If you haven't subscribed to this YouTube channel, we ask that you do that now. Please subscribe. It helps us out and gets us to more people. We want to thank you for joining us today, and we hope that you will come back and see us again. Have a great day.